Afternoon, ladies and gents. Simon Brown here doing today's webcast. Excuse me. So today's webcast, we're looking at the tax-free savings accounts in which you can trade some 39 ETFs. And into that, we're saying, well, hang on, we've got some trading systems that perhaps we can put in there. And trading systems that do nice enough, but would they do better if we didn't have to pay tax? I mean, if you go look at my momentum videos, 2 years to end February this year, the mid-cap one had done over 100%, which makes it the best portfolio out there. I mean, if it was a collective investment scheme, properly registered and all, we would have been number one over the period. But that's before tax, and tax hurts. You're going to get taxed at your max marginal rate, and the tax is going to be significant. So we figured, let's look at these tax-free savings accounts. Let's see what the story is. They are for individuals only. Remember the caps, 30,000 per year contribution and 500,000 over a lifetime. Those will increase. We expect them to go up in time. I imagine that the 30 and the 500 will both be increased as the relevant minister does their budget speeches every year. Probably not by a lot, probably sort of an inflation amount, but that's fine. That will increase over time. There are now 39 ETFs that you can buy. The new core shares top 50 came in earlier in June, making it 39. You pay no tax. That's the absolute beauty of it. And in many cases, very, very cheap to transact. And those are two big deals, particularly the tax. So what we've done in the past is traded the shares. And we thought, well, let's have a look, let's try this, and let's see if we can't perhaps do it with an ETF in a tax-free savings account. Now, the legislation at no point says that you can't trade frequently. It basically, you can buy and sell 100 times a day if you wanted. You can, the transactions are not the issue. The point being is it's a case of, well, okay, so if we can do that, let's maximize it. And as I said, I've gone back, I've checked the legislation. There's certainly no limitations on frequency of trade and the like. And this is probably an unintended consequence. Doing this is not what SARS planned these tax-free savings accounts for. Make no mistake about it. However, when I look at it, I can't see how they get out of it, how they close the loophole. And if they do, well, then we'll move to that plan when and if they do. But at this moment in time, we certainly can. So two systems that we have, the Momentum and the Lazy, both simple, of course. I mean, that's just the plan. Momentum, any tax-free savings account ETF. In other words, and I'm not going to delve into the methodologies behind the systems. I'm taking it as a given that folks are aware of it. There are the videos on the Just One Lab website, which you can go and find more information. The Momentum one basically buys the winners. So you do a scan. You would scan the 39 ETFs, and you would say, right, which are the best movers? And it always stays invested. And you buy those best movers, and then you rotate on a basis. I've been doing it annually. You could do it 6 monthly. You could do it quarterly. Because the costs and tax are no longer an issue, costs are significantly less of an issue, we could actually pull that down. Part of the reason I've always done it on an annual basis is to try and reduce those costs to a process. The Lazy system, so I've traded selected ETFs with that in the past, and it's not always invested. So at the moment, my Lazy system is only 1/4 invested. Of the 4 ETFs I trade, or the 4 indices, midcap, Resi, Fini, and Indy, only my Indy is still in a trade. I've been stopped out of Fini and midcap during the month of June. I haven't had a Resi trade in years, I suspect. So that's much more a lot of cash in it. And in that sense, the cash, where the Lazy really comes into its own is in severe market corrections when the system goes into cash and you really spring ahead. I remember back in 2008-9, the market lost 50% top to bottom. My drawdown was only 15. So it puts you nice and well ahead of that process. If we delve into them, it's the 39 ETFs. You basically do the scan. You buy the top 5, top 6. So I put 6 there. I've always bought the top 5 and the top 14. We've got 39 essentially, and there's some duplicates in there. There's some indies, but different ways. There's the Satrix Indy and the Givy. But for example, in the top 40, there are 3. They're 2 property ones. So in that sense, I'm saying, well, okay, let's stick with 5, because when we've pulled out duplicates, we're probably at about 35 of those ETFs in total. And then we hold them for a year. So we scan, we buy, we hold for a year, we rinse and repeat. And we see how that goes in a sense. And talked about changing durations. We can certainly look at the different durations that are coming through. EJ, if you sell the ETF and keep the cash in an account, is it regarded as a withdrawal? So it's not. It's a great question. A withdrawal is literally only when you take the money out. So you sell the ETF, you got cash, you either leave the cash, you buy another ETF. It's not regarded as a withdrawal. And that's the key benefit of it. So the transactions are not withdrawals. The lazy system, using a series of exponential moving averages. As I said, you'll find the full system detailed on justonelap.com. So we trade 4 ETFs: midcap, resi, indie, and FINI. Well, we trade the indices, but we don't buy the index. We then go and buy the ETF. They're long only, as is the other one, as is the momentum. So we only go long. The momentum will take pain in a bear market. This doesn't take as much pain because it goes into cash. So which one do we look at? For me, it's about momentum. It works better, particularly with lower cash. It gives better return, yes, but then you get hit in the bad years. I wanted to go back. So the better return is over a complete cycle. Look at it over 5, 7, 10 years, not just the last couple of years where, well, up until this year, the mid cap's done great and the top 40's done all right. And it's ahead of the benchmark. What was it? May was a fairly rough month for us in many senses. So I'm going to focus on the momentum one. The lazy is equally possible in there, but to me, I want to focus on the momentum. So we'll do some live scans. There's an important point in my data, and I've spoken to the chap and who provides my data, but I am missing 2 of the 39. The RMB top 40 is not a problem because I've got the Cetrix 40 in there, so that'll catch it from there. If it told me to buy Cetrix 40, I would buy RMB top 40 because it's cheaper. Tighter spread, lower total expense ratio, so I'd buy that one. The div tracks, which is the core shares. Core shares is a Grinrod. They changed their name to core shares in the ETF space. The div tracks, I can't find it. I just can't find it. It's a problem. We'll solve it. But let's pull up my other computer. So that's and here's one of the problems. So we happen to be looking at the Stanlib Swix, and you can see some dirty data there. And there's some, so the highs don't bother me, those, but the closes, that close there is just, it's just a wrong close. Ditto with that close there. And that's because they pull out in the closing auction. So they exit in the closing auction, and then we're going to see some spikes like that. So we're going to have to always interrogate the data. So what I've done, I need to go to my other mouse here. I have my, delete that. I have my list of all of the 39 ETPs. Let's pull that across a little bit. So there are my 39, notwithstanding the 2 that I said we're missing, the complete list, so it's only 37 of them. So what we do, question coming through, what software is this? It's AmiBroker. So first what we do is we filter to make sure we've got the ETPs only. So first let's go and do yearly returns, but let's go back a year. So let's go back to, and I'm just going to pick we're in June. So let's go back to 1st of June of last year, which was a Sunday. So we go to 2nd of June. And let's therefore scan that. So what we've done here, we said a year ago, these are the ones that we would have purchased. Okay, so those are the ones that we would have taken, which then gives us, let me use this mouse rather, Deutsche Bank, Europe, it gives us the Givi Indy. Those are from ABSA. They used to be RAFI Indies, they're no longer. The NF Sharia 40, which is odd, but nonetheless, the Sharia share. Deutsche Bank US and New Funds, which is another ABSA product as well. I just want to, what I want to do here, and I'll shut this down. I want to go check them. I want to go make sure that the data was all clean. So there's the Sharia. You can see we get some really ugly looking data here. Let's zoom out. Oops, we don't need to go so far in the zooming process. We need to go back to about June. So what I'm looking for here is, was there any bad closes? Now that looks like a less than great close, but it's 7th of June. So we're going from 2nd of June. I'm in a weekly chart. That is why it looks so, look at those. those candles. I mean, they're not the end of the world because the opens are weird and the closes are looking better. But nonetheless, those are ugly candles. But that's fine. That's not going to cause us any stress in particular. So we zoom back, gone too far. We're looking. So what I'm checking is 2nd of June, did we get a decent looking candle? Yes. So my Sharia on the 2nd of June, the candle looked fine. If we bring it forward and look back, sorry, not forward, backwards, and look back over the previous year, let's rather just zoom out. And we go back to the previous June, because remember we were doing June to June. It's looking fine. So that's the one. What were my others? Let me sort. We have the. Did we have a Givey in there? Yes, we had a Givey Indie. So again, June. Those candles are fine. So that candle's fine. Then we take it to that June there. Don't be that candle on me. No, it wasn't. And that candle's fine as well. So I've gone through and I've checked them all to make sure that the candles were all clean. I did that before we came into the webcast. So each of those candles is clean, and we can go and we would check each of them individually and say, well, okay, cool. So that worked. Those are the five. It is the Deutsche Bank EU, the Givey Indie, the New Shares 40, the DBX US, and the new funds. And if we go back to that, what we can see is that SWIX, and in fact, both the SWIXs are fractions behind. So what I want to do is go and test if we have got, now I need the code. I just want to see if there were chunky dividends that would change the picture. So new funds, let's go see if new funds had a dividend that would change the picture. And I don't know what the code for new funds is. I'm assuming it is. No, it's not. I think it's new FSA. Is that it there? No, let me check it this way instead. Slightly slow interconnection. We are rocking here. Where is it? Okay, so new funds. So it is the new SA. Okay. New funds SA is it. Dividend. Yep. So there's some not bad dividends there at all. And in fact, no, I don't have Java. So we then check them. Why am I checking this? Because we're so close that you want to make sure you get the right one. So we're sitting here on a dividend yield of about 2%. Next in line was NFSWIX, which is the SWIX. Why am I checking that? Because they're just behind. So if that's got a better dividend yield, then we would be in there. So NFSWIS, I'm going to go just straight back to this way of doing it. And it will be, there it is, the new funds SWIX, and a lower dividend yield. And then the final one was Satrix Indie. So I'm not going to bother with the Satrix SWIX because it's the same as the new fund SWIX. Let's check the Satrix Indie, see what sort of wrong. Satrix Indie dividend yield 1.3. Okay, so short answer, we're in biz. It agreed that those are the five that we would be looking to buy. So then what do we do? Well, okay, what was their return? So let me get onto the right screen. Let's bring it. We're not going to do it to today. We're going to do it. I'm just going to hit that for now just to make it easier. We will again do it until the 1st. So that would be the 12-month holding. And then we show. So what were the funds that we had? And let's sort them by alphabetically. So the 5 funds that we had, DBEU, which gave us 2.6%, DBUS, which gave us 27.5%, Givey Indie, which gave us 9.2. What else we got? The NS40, which gave us minus 13%, and then the new fund which gave us 3.1. So if my math is correct, we've got ourselves a 12 minus 1, 28, call it 32. Divide 32 by 5. We've got about a 6.5% return over that 1 year period, excluding dividends. So I'm just going to take an assumption here. Let's say we can add 2% in for dividends. So we've got around, what have we got? So we've got about 8.5%. Let me note that down. 8.5% does not sound thrilling, but let's see what our benchmark did, which was top 40. So I'm just going to go change my filter to top 40 over same, not to top 40, to lazy. So that's the indices in there. Show. Top 40 is done 3.5, add 2% dividend, call it, yeah. So that therefore did, call it 5.5%. So we did 8.5, the market did 5.5%. So short answer, we are ahead of the curve. It came out ahead. We beat it by a very modest 3%. I suppose we could do a slight blend of it, because the question then is, well, okay, hang on. What did my two preferred ETFs do? And let's, for that same period, my two preferred, and let's sort them. So I did 1.8 on Beta Beta, which is my one preferred, and then DBX World did 20. So in truth, I would have been better off in just those two preferred ETFs. However, what I'm suspecting is that, you know, in some years those two are going to be the winners, and because we had world, in fact, all of the internationals except for the UK did very well over the period because of rand weakness. So, but rand weakness is not a great reason. So, the methodology beat the benchmark top 40, did not beat my two preferred ETFs, Beta Beta and Data and the Worldwide, which is the two that I currently hold in my tax-free savings account. So it won and won, but not in the other. Excuse me, but more importantly, it beat the one that mattered, and we can do this for you know as many different years as we want. So wrong mouse again. Let's quickly go back to June. No, not 14. I want June 13. 3rd of June there. And show. And I would have had DBXEU, I would have had STXIND, I would have had DBXWD, DBXUS, and DBXUK. So that's what I would have bought on June of 2013. We spring it forward a year to June here, and we show, and we sort. My returns were for the EU. My return was 28. I'm going to round it. For Satrix Indy, I can't see that there. I need to scroll down. Satrix Indy did 22.3. Deutsche Bank Worldwide did 22. The US did 24, and the UK did 21. I'm dropping the roundings here. So by my count, that is 111%. We divide that by 5, gives us 20, call it 23%. Add some divs in, let's call it 25%. So let's jump forward a year and see how our benchmark did. Going far too far. And filter on lazy so that I can get my top 40 return. And we show me top 40. So top 40 did 19.6. Add divs, let's call it 22. We did 25. So we are beating but we're not beating by a massively large amount, but we're certainly ahead of the curve. And I went and did a whole bunch more testing and back tested it and the like, and it seems to be that we beat it in pretty much all the periods. And I'm just picking June as a random period, and I'm doing it for a month. But in all the periods that I go back and test on, we are coming out ahead. So not by a lot. We're not beating it by dozens of percents, but we're certainly beating it by 5 or 10% a year. And that becomes significant in a tax-free savings account when you do that for a significant period of time. So let's go to yesterday and let's filter on ETPs. And let's show them. So these are the 5 that we would be buying today. We've got Japan. We've got the US again. We've got PropTrax 10, and then we've got 2 more properties, PropTrax SPY and StratProp. Now, those 2 are exactly the same. So I would buy one of them. I would check their TERS, and I think it's the stat prop that I would probably buy, but I would drop the other, which gives me 2.4, and then I come in with Deutsche Bank World again at my 17.6. So those would be the 5 that I'd be looking for at this point in the equation if I was to be doing it effective today. So the short answer is that this is working for us. It's lacquer, it works, it happens, all's neat and dandy. But when do we start? Do I kick it off today? And I'm not. So 1st of March this year, whatever it was, 3rd of March, the first Monday, I opened my account, I put my money in, I went and bought my 2 ETFs. But I've only got 30 grand in there. And in fact, I think they're probably slightly underwater because of the tough times we've been having lately. So I'm going to wait for 1 March 2016 when I can put another 60 in. And then I've got, another 30, and then I've got 60,000 in the account. And the reason I'm doing that is because although the costs are very cheap, when the difference between a 6,000 rand trade and a 12,000 rand trade is not insignificant in the fees. So the point being is that it's probably going to save me a couple of hundred rand, but again, per year over time, it's going to significantly add up. So my sense is, yep, I'm going to run with this. I'm going to start it, but I'm only going to start at 1 March. I'll put another 30,000 in. I'll sell the 2 that currently exist in there, which is my Deutsche Bank and my BBET 40. And I'll hold those in separate accounts as well. But in the tax-free savings account, I will sell them. And then I would do that scan for 1st of March and kick off then, along with the other momentum. And in time, this, the question coming through is do I stop doing the share momentum? At this point, no. My share momentum portfolio is, 250, 300,000? I'm not sure. It's around about there. So, it's significantly bigger. In time, this will get big enough. And when, in 16 years, we've got 500,000 plus all the profits and everything, we're at $1 million, then maybe we do. But for now, the 2 will run sort of in sync with each other in order to fully capitalize, just because even 60 is not a massive amount. And even if Minister Nene gives us, say, another, 5,000, 63, 65,000 is not massively huge. So short answer, it works. No surprise, I expected it to work. It doesn't. I'll be honest, I expected much bigger outperformance. I thought we would get massive outperformance, and we didn't. But we got the outperformance. And I think I know broadly, when you're doing this with individual stocks, you can find shares that do crazy stuff. A year when the index does 5%, you can have an individual stock in that index doing 100%. And if you're on that boat, you're going to wing it. It's unlikely that any equity index or any of the methodologies that are used in these ETFs is going to do that level of return. And in fact, when we run the scan, if I pull that screen up again, these are nice, but they're not the most awesome returns in the world. If I went and filtered on let's do mid-cap in particular. So here we've got stocks, they're 20, 25%. If I do the same in equities, we've got a dozen or more that have done better than those indices. Of course, this is going to cut both ways, but the point being is that it's doing much better, and we will always do significantly better in the space of shares than we will over indices. That's just to be expected. Even in the top 40 space, we've got a whole bunch that are doing a lot better over the year than an index does. And as I said, that's just the nature of the difference between indexes and shares. The point being, it's moot. because in a tax-free savings account, we can't trade shares. So what we're really doing is adding a couple of percentage points. Maybe it's only 5 a year over time. You add 5% a year over time, that really, really stacks up. So it becomes hugely significant. Questions, pop them in the Q&A box. We've got a couple coming through. The Givey Growth Intrinsic Value Index, I think it stands for. So ABSA used the RAFIs as their methodology, Research Affiliate Fundamental Indexation. RAFI's no longer doing it or something. So they've had to pull their products from that, and they went with Givey, which is a S&P Dow Jones product with the methodology. I don't know the details. I'm going to interview Wayne in a couple of weeks' time on JSE Direct, and then we'll get a much better sense of exactly what and why and how and the like. So that's where those came from. Core Shares 50. Yeah, so Core Shares 50 is the new one from Core Shares, which was Grindrod. It's the top 50. I don't know their methodology. Again, I'm going to have I'll do an interview with Gareth Stobie and chat to him about that and find out. But it's not here yet because I don't yet have a year's data. That thing's not even a month old yet. So I didn't even have a year's data. Kaputso, can you give us performance figures over 1, 3, 5, and 10 years? So I haven't gone as far back as I think I went back as far back as 5 years. I haven't gone back as far as 10. So I mean, what we're seeing is the numbers as I threw out to you there. Over 1 year, we did about 8.5. The year before that, we did about 25. And running from my memory, because I don't have my notes in front of me, the year before that, it was about 18. But if I look at a 5-year return, we probably outperform by about 5%. That's not taking costs into account, but costs are going to be very, very modest, of course. So costs don't stress me in the least. Do I think SARS will ever let us trade shares in our tax-free savings account? No, I don't. And here's why. So the thing with an ETF is never going to go to zero. An index is not going to go to zero. As soon as they put shares in there, you stand that risk. Now, they could say top 40 shares only, but then you could buy Kumba at 600 and turn it into 150. And what they're trying to do here is create savings for the long term. And you buy Kumba and destroy 75% of the value of your portfolio, and boom, worse, you buy African Bank. They weren't in the top 40 at that point, of course. But so for that reason, I think we're never going to see individual shares. I think it'll only be those ETFs. I think that basket of ETFs, currently it's 39. I think the quantity will increase over time. That I certainly do. Cool, ladies and gents, there are some more coming through. So, Kumutsu, you're asking which ETFs I have currently. It's hold on, wrong keyboard. BBET40 and DBXWD are the two that I currently hold. And the one that I will add will be PTX10 would be the one that I would add. But as I said, what I'm going to be doing is from next year, I will sell those two out at whatever price they are, and then move into the ETF space. At one point, someone's asking about the dirty data. So I brushed over it, but I didn't. So what happens is the way the process works is that the ETF issuers are not in the market. ETF issuers are not in the market in the first 10 minutes of the day or the last 10 minutes of the day. So you often get some crazy trades going through, and that therefore gives you that dirty data. So we need to always go and double check on that data. But ladies and gents, we'll leave it there. So what we will do is we'll kick this off and we'll put it up as a portfolio on the site. We'll kick it off 1 March as of next year. A couple of you are saying 1 March is 100 miles away. Yeah, okay, I'll ponder on that. The other thing I'm going to also do, and I'm going to run the tests, and I started doing them, is let's look at shorter time frames. Let's look at doing it on a 3-month or a 6-month. I'm not convinced that's going to necessarily give us, certainly in the equity space, the short time frame didn't, if anything, it hurt returns rather than improved it. Could we do it right now? We could. You got 30,000 Rand in there. That is, 5 ETFs, so 6,000 Rand per ETF, but check your costs. Costs are going to be critical.